This is start of the month. End of the week. And something just happened that should not be possible in a functioning market. Silver did not drift lower. It didn't ease into weakness. It fell straight through levels that were supposed to slow it down. Hours. Not days. Gold followed. Hundreds erased as if they never existed. If you're watching prices right now, your instincts are probably screaming at you to react. That is exactly why you need to pause. Because what you're seeing on the screen is not telling the truth about what is actually happening. Markets are supposed to send clear signals. When prices fall hard, supply should appear. Sellers should step in. Inventory should become easier to access. That is how price discovery works. That is not what is happening here. Instead, prices are collapsing while availability is vanishing. The lower the screen price goes, the harder it becomes to actually obtain the thing being sold. That is not volatility. That is a contradiction. And contradictions are where real market stress hides. By the end of this video, the disconnect will be impossible to ignore. But first, you need to understand why the early signals are being misread. The explanation arrived instantly. Too much speculation. Too much leverage. A crowded trade finally breaking. The kind of story that feels neat and final. It sounds reasonable because it's familiar. Every sharp sell-off gets wrapped in the same language. Excess cleansed. Reality restored. Lesson learned. But familiar does not mean accurate. In a real liquidation, everything tied to the asset collapses together. The price falls, the ecosystem around it fractures, and anything dependent on future revenue gets repriced violently. That did not happen. Yes, silver fell hard. But the collapse behaved selectively. Some parts of the system absorbed the impact. Others barely flinched. That alone tells you this wasn't a simple sentiment shift. Markets driven by fear do not discriminate. Markets driven by mechanics do. And that distinction matters, because one implies opinion, while the other implies enforcement. At this stage, most people stop asking questions. They assume the move explains itself. That assumption is where the mistake begins. Here is where the market quietly breaks its own rules. In a normal environment, falling prices invite sellers. Inventory loosens. Buyers wait. Scarcity eases. The system balances itself. This time, the opposite occurred. As prices fell, supply tightened. Physical silver became harder to source. Not in one country. Not in one region. Across continents. That should immediately raise alarms. Because a price that falls while real-world supply disappears is not a clearing price. It is a forced price. It means transactions are happening in one layer of the system that are not being validated by the layer that actually handles material reality. That is not theory. That is logistics. You cannot trade away physical shortages with paper contracts forever. At some point, the abstraction collides with the thing itself. This is the moment most people miss, because it does not show up clearly on charts. It shows up in availability, delivery delays, and rationing behavior. And once you see that, the question changes from, why did the price fall, to, who was forced to sell? Modern markets are not governed by belief. They are governed by collateral. When volatility rises, margin requirements rise with it. That is not a suggestion. It is a demand. Traders must either add capital or exit positions immediately. Most cannot add capital fast enough. So they sell. That selling pushes prices lower, which increases volatility, which increases collateral demands again. The spiral feeds itself until only the most liquid participants remain. This is not price discovery. This is system defense. And when this mechanism activates, the resulting price reflects who was forced out, not what the asset is worth in the real economy. The silver move had this exact fingerprint. Speed. Timing. Uniform damage to leveraged positions. And then tightening rules after the damage was already done. That sequence matters. It tells you the system was not calming the market. It was finishing the purge. Once you understand that, the behavior of the physical market stops being confusing. Physical markets move slowly. Mines do not expand overnight. Industrial demand does not vanish in a weekend. Supply chains cannot react at the speed of margin calls. That is the imbalance. Paper markets can create instant supply by selling promises. Physical markets cannot create instant material. When paper selling accelerates under collateral pressure, prices fall regardless of physical conditions. When physical conditions are tight, that fall does not create abundance. It creates stress. That stress is visible now. Premiums are expanding. Availability is shrinking. Rationing language is appearing. These are not signs of a healthy market responding to lower prices. They are signs of a system under strain. At this point, the screen price stops functioning as a signal and starts functioning as a weapon. It forces behavior without reflecting reality. And that is where this story becomes much larger than silver. This pattern is not new. It appears whenever a strategically important commodity experiences rising demand, constrained supply, and heavy financialization. The sequence is consistent. First comes enthusiasm. Then leverage. Then collateral enforcement. Then forced liquidation. Then silence. After that, the real adjustment begins. The participants who can survive the collateral regime remain. The rest are removed at the worst possible prices. Assets transfer hands under the cover of market discipline. This is not conspiracy. It is incentive. Clearing systems protect themselves. Large capital survives. Smaller capital does not. The market calls this efficiency. The result feels like extraction. Once you recognize the structure, the current behavior stops looking random and starts looking inevitable. Another signal is impossible to ignore once you see it. The selling pressure has been concentrated in financial hubs that trade paper. The buying pressure has been concentrated in regions that demand delivery. One side is selling claims. The other side is removing metal. This is not ideology. It is behavior. The more aggressively paper is sold, the faster physical inventories drain. The lower the price goes, the more attractive real metal becomes to buyers who do not trust promises. That creates a paradox. The crash accelerates the shortage instead of relieving it. And paradoxes are where systems fail. This is not about predicting the next price move. It is about understanding the phase shift. When forced liquidation ends, price stops being driven by collateral and starts being driven by constraints again. That transition is rarely smooth. Volatility remains elevated. Premiums linger. Availability stays uneven. Confidence does not return all at once. The paper market may stabilize. The physical market may remain tight. That divergence can persist longer than most people expect. This is analysis, not financial advice. It is about recognizing how stressed systems behave. The key point is this: abstraction can delay reality, but it cannot override it indefinitely. At this stage, the market is no longer functioning as a single system. It has split. One layer clears through forced selling and collateral rules. The other clears through scarcity and logistics. When those layers diverge, price loses its authority. That is the real shift already underway. Not a future prediction. A present condition. Once a market shows you that split, it does not quietly heal. It becomes more fragile, more political, and more prone to sudden dislocations. And those dislocations rarely warn twice. The simplest way to understand what just happened is this. They dumped silver. And the world ran out of it. That is not how a real market behaves. That is how a system behaves when paper claims collide with physical limits. The screen price fell. The metal disappeared. One of those is real. Once you see that, the crash stops looking like a verdict and starts looking like a signal. And signals like this do not fade quietly. They reshape how everything that follows must be understood.